So let's take stock of all our mutual fund investments and let's figure out what to do in 2018 and which are the best mutual funds to bet on. And who better than Dhirendra Kumar, the CEO at Value Research, to join in and tell us all about what are the funds that we should bet on for the new year. Dhirendra, good morning. Let's start with the young and restless, people who are willing to put risky bets into the markets, who are willing to put their money on small and mid caps. Where do you think in 2018 they should be putting their money?
Of course, I really don't want to comment on, who should, if an investor has decided that he is, willing to take downside in the entry and want to, maximize his return, mid cap and the small cap funds are the way to go. But one has to be a little careful because, here we have a choice. And the range of return, the return that you derive from, the best mid or small cap fund and the worst mid and small cap fund can be very wide. So one has to be a little careful. I think, investors should consider this. One rule which I would say that, it is an accumulative vehicle. Being regular investor actually benefits because, you are able to average and even if you have sizable large amount of money, large sum to invest, you should still spread it over a period of time. So consider your options, in small and mid cap fund. If I have to choose some, then I would say, the principal emerging blue chip fund looks very promising, a very high quality, fundamentally guided portfolio. That's one. SBI mid cap, which is focused on turnaround situations, some structural growth stories, that's another, looks very promising. And the other one which comes to my mind is, L&T mid cap. This has been one of the most consistent ones, and also, it's largely tilted to mid cap, but always, had fairly, nearly a third of the portfolio is always in small caps.
The second category, Dhirendra, when it comes to the second category of what should one be investing, what should one look at?
I would say, optimistic investor looking at, equity. Of course, the method has to be always, even if you have any amount of money and you are getting excited by the market, feeling the getting the feeling that, you have missed the bus, you have to ride it quickly, resist that because that could turn out to be very injurious. And also, broadly investors should be guided. All the categories which we are mentioning, that cautiously optimistic or, aggressive investors or, the young and the restless, that's fine. But, there is one thing that you have to really experience the market and experience the market and the how important that money is in your overall scheme of things. That is so these are two crucial things besides how much you should always be investing your long term money. For those investors, the cautiously optimistic investors should consider the large cap funds, and my choice includes ICICI Prudential focused blue chip, Motilal Oswal focused 25. Not a relatively young fund which has done exceedingly well, looks most promising. It's not hugging the benchmark at all and limits its portfolio to only 25 stocks. And Mirai Asset India Opportunity, stellar performer, most consistent, also guarded downside when it faced in 2011.
What about those who want to play it safe, those who want the best of both worlds? They want the exposure to equities, but they want to balance it out with some debt exposure as well, looking at balanced funds. What should they be doing in the next year?
I think most investors need, even, the other two categories which I have mentioned. In fact, those investors should also, those kind of investor, if they are investing for the first time, they should always start with a balanced fund. And I think the coming year also is going to be very useful and I think materially more rewarding for balanced fund investor, because the rebalancing that happens in balanced fund and the the ups and downs, the extreme volatility that we see in the interim, and the rebalancing that the balanced fund does will translate into superior return. We have had a phase of market where balanced funds were able to beat even the multi-cap funds and the large cap funds, and those periods have been fairly prolonged. That apart, yes, it is a steady take on growth. So consider balanced fund. Most investors' need gets fulfilled by this. My selection includes Aditya Birla Sun Life 95, among the oldest, consistent and fairly predictable equity portfolio. HDFC balanced, great returns, and it has been very different from the pack of HDFC equity funds which struggled. And ICICI Prudential balanced, a fairly conservative portfolio, and over any time period, on any 3-year time period, it beats all others.
As much as we may be celebrating that DII participation figure, the fact that mutual fund inflows are at an all-time high, there's still a very large section of the retail population that believes that stocks are risky. So what if someone is just looking to play it safe, someone who wants those very predictable investment ideas and doesn't want to invest in stocks at all, is only looking at a fixed income exposure? What should they be doing?
Oh yes, India has largely been a fixed income country. Investors, love that, and it's very hard for them. And also, fixed income funds can actually fulfill the needs of people who are short-term investors. Investing for any time period, for 3 years and less, you should consider this. These will, and be very conservative. Don't try to optimize your return or maximize your return on fixed income fund. Because these investors, whenever they face a decline, it turns out to be extremely painful, and it's very difficult for them to reconcile with those 2% decline or 3% decline, as we are witnessing right now. Many investors bet with the dynamic bond fund, which look very disappointing. So be extremely conservative with this, and my selection includes the short-term funds and the ultra short-term bond fund for parking your money which you need in the medium term. Aditya Birla Sun Life Treasury Opportunity Fund, Optimizer Fund, DHL Primerica's medium term income fund, and HDFC medium term opportunity fund. These funds, they have given outstanding return nearly 10%, a little over 10% in the last 1 year. Don't expect that; it will be a little lower. But downside is completely guarded. You will now not get a bad surprise, and if you turn out to be an investor of 3 years and more, the tax efficiency will kick in terms that all the gains will be treated as capital gains, and you will derive the great advantage vis-a-vis a deposit.
Go through the categories once again. Young and restless, for those who are, let's say, taking a plunge in this category, what should be the return expectation? What should be the risk in percentage terms, if we can talk about it?
I don't know about the percentage, but this category turns out to be the most rewarding, and if you look at the past, it beats the benchmark by twice as much. So if you are optimistic about the market, and averaging will actually optimize your return further. The risk, if you are investing for next 5 years in a mid cap fund, and say two years down the line, your accumulation is whatever, if you are investing 10,000 rupees and 2,40,000 invested, it actually becomes 4 lakh rupees or some such thing. And so be ready for a 60% decline in a month's time, and it happens quite often. We have witnessed, if I recall 2008, the 70% decline in the small cap fund was quite stomach churning. So those are, of course, I don't anticipate at 2008 the convergence of all the bad news and a great coincidence where everything happened at the same time. But be prepared for that and try to benefit from that. The only way to benefit from that is be regular investor, never invest lump sum.
Oh yeah, absolutely. But Dhirendra, you know, if one is looking at picking out a particular kind of funds for 2018, while mutual funds, of course, should be an instrument wherein you regularly, systematically, monthly put in money, not in lump sum for at least 5 to 10 years. That's an ideal scenario. But if in the more short term, one is looking at the next, say, 1 year, for instance, would you say that fixed income is a safer bet, or would you say it would continue to be equities which would make you more money?
I think that, you know, equity is not correcting, and many investors have, you know, lost the opportunity by waiting, or, you know, endlessly waiting. But, you know, 1 year time frame, if you have only 1 year, then equity is ruled out. And generally speaking, I'm still optimistic about equity, and one has to be careful with the kind of funds you invest in, because now we will start witnessing, you know, the laggards and the winners, because so far even the poor funds have done reasonably well over the last 3-4 years.
Okay, now let's close it with the retirees. Dhirendra, what should one do? Because the retirees are frankly feeling the heat, which could be called as huge, because saving rates have come down.
Yep. Yes, this is one thing, you know, which is actually contributing to the market's growth, you know, the flow as well, and for them it is a necessity. I don't think it is a matter of choice for retirees to avoid equity, because if you look at, you know, the decline in interest rate, it looks like, you know, 1.5%, 2%, or but interest rates coming down from 9 to 7 for them effectively translates into, you know, a 30% decline in their income. That is substantial. That is very hard to reconcile and, you know, reset their income needs. So retirees have a very definite need that there should be income, and income based on that capital should be inflation adjusted, meaning with rising costs it should grow, and the only way to do it is, you know, have some meaningful exposure to equity in a manner that you can at the same time your you know, appetite for the volatility will be low. If you see, you know, you can't really be investing in the small and the mid caps where you see a blow up of 50% for 1 year, and that is the time if you're pulling out, you eat your capital. So that drawdown can actually be a devastating thing for retirees. So for them, I think, you know, the simplest way is consider the equity income funds. These are nearly a third of it is in equity, a third of it is in fixed income, high yielding fixed income, and a third of it is in arbitrage. And that gives it the character of an equity fund. The tax treatment is like that of an equity fund, and it is relatively, you know, it's substantially low on risk. And so this is one simple option. Even the balanced fund that I mentioned, if you invest in a balanced fund and keep your annual withdrawal rate to 5%, and then I think, you know, balanced fund can also, you know, meet your income needs, and in a manner that you will be able to increase your income with inflation. It will get inflation adjusted more meaningfully. So for conservative investor, you know, the equity income fund, and if I have to recommend some or, you know, suggest some, the ones I like: HDFC Equity Savings, ICICI Prudential Equity Income, and Reliance Equity Savings Fund.
You know, as we wind down the year, I think it's important to also look at who's got this year right, who's not got this year right. So if you have to really look at, let's say, an evergreen fund manager and someone who's really got 2017 right, who would that be? Prashant, whose contra bet finally paid off, or somebody like, you know, Ramdev, who's been evergreen with earnings and is giving consistent returns?
I would clearly choose Ramdev, because, you know, he actually reflects clarity, didn't get distracted. So has been Prashant, but I think, you know, because it still has to, you know, gain ground. Of course, you know, he has been able to recover. He has recovered the whole year in few days, but you know, we still have to really build up. We have to see how things happen, and his orientation, you know, is it can't be measured, or you really can't really pass a judgment based on a calendar year.
And on the fixed income side, Dhirendra, because that's where again this has been a very it's been a year where you made money by first betting on the long end, then on the short end. So it's been a dubious year also, or tricky year for fixed income fund managers also.
Yes. Oh, fixed income manager, they had the toughest time because, everybody waited for the rate cuts which didn't happen. It happened when not too many people were expecting. Then we had the credit blow-ups, which was actually a turning point in the industry for the mutual fund investor. And the calamity, we saw the decline of, the credit opportunity funds, and the surprises that we got. Despite their quality orientation, what we witnessed was that a small blow up in a fund can drive investors to pull out, which can drag a fund company. So it has been a very tough year. And if you look at the returns of the dynamic bond funds, you find who all went wrong. Some, many investors are questioning that, are they really worth it? The return from these funds is lower than the expense that you incur.
Okay, Dhirendra, great speaking with you, and thanks so much for enlightening our viewers in their individual categories on what funds they should bet on for 2018. And yes, wishing you a very happy new year from all of us.
Thank you.